Insider exchanging is the trading of a public corporation's stock by somebody who has non-public material data about that stock. All through the whole history of the U.S. Securities Exchange, there have been numerous people who have utilized their admittance to insider data to acquire an unjustifiable edge over different financial backers. William Duer is broadly viewed as the first to have involved his special information in a plan that included conjecturing on bank stocks. Duer was named by Alexander Hamilton to act as the Associate Secretary of the Treasury in 1789. A half-year after the fact, he left his situation after it was found that he was exploiting his admittance to private data to guess on stocks and bonds. Albeit the Securities and Exchange Commission, SEC, has rules to shield ventures from the impacts of insider exchanging, occurrences of insider exchanging are frequently challenging to recognize in light of the fact that the examinations include a great deal of guess. In that capacity, while insider exchanging is found, it is frequently dubious and might be questioned. Instances of insider exchanging likewise will generally catch bunches of media consideration, particularly on the off chance that the blamed individual is a person of note whose standing might be in question. The following are 4 striking instances of insider exchanging, starting in the mid-20th years and crossing into present-day times. After the Wall Street crash of 1929, it was uncovered that Albert H. Wiggin, the regarded head of Chase National Bank, had shorted in excess of 40,000 portions of his own organization. Utilizing organizations that were claimed by his family to conceal the exchanges, Wiggin developed a place that really gave him a personal stake in destroying his organization. At that point, there were no particular principles against short-selling loads of your own organization. Thus, in the fallout of the 1929 accident, when a wide range of financial backers left their places of Chase National Bank stock simultaneously, Wiggin legitimately made more than $4 million. Notwithstanding the benefits he produced using the short selling of his own organization's stock, Wiggin had likewise acknowledged the benefits of $100,000 every year for life from the bank. He later declined the benefits because of fights from the general population and the media objection. Wiggin was not by any means the only bad entertainer during this time. The Securities and Exchange Act of 1934 was passed to some degree as a reaction to the far-reaching defilement that was uncovered in the consequence of the accident. Expanding straightforwardness in the monetary business sectors and abatement occurrences of misrepresentation or manipulation was planned. Ivan Boesky is an American stock merchant who became notorious for his job in an insider exchanging outrage during the 1980s. This embarrassment additionally elaborate a few other corporate officials, utilized by major U.S. venture banks, who were giving Boesky tips about forthcoming corporate takeovers. Boesky had his own stock business organization, Ivan F. Boesky & Company. And beginning in 1975 when he opened his firm, he brought in tremendous measures of cash theorizing on corporate takeovers. In 1987, after a gathering of Boesky's corporate accomplices sued Boesky for diluting lawful arrangements enumerating their organization, the Securities and Exchange Commission, SEC, started researching Boesky. It was subsequently uncovered that he was going with his speculation choices in light of data got from corporate insiders. Boesky had been paying representatives of the venture banking firm Drexel Burnham Lambert engaged with the Consolidations and Acquisitions (M&A) branch for data to assist him with directing his purchases. Boesky wound up benefiting from virtually every major M&A bargain during the 1980s, including Getty Oil, Nabisco, Gulf Oil, Chevron, and Texaco. Boesky winding up helping out the Securities and Exchange Commission, SEC, and turned into a witness, giving data to the SEC which in the long run prompted the argument against the lender Michael Milken. Boesky was indicted for insider exchanging 1986, and got a jail sentence of 3.5 years and was fined $100 million. In spite of the fact that he was delivered after just 2 years, Boesky has been for all time prohibited from working with protections by the SEC. R. Encourage Winans was an editorialist at the Wall Street Journal who composed a segment called Heard on the Street. In each section, he would profile a specific stock, and the stocks highlighted in the section frequently went up or down as per Winans' viewpoint. Winans organized an arrangement where he released the items in his section, explicitly the stock that he planned to detail, to a gathering of stockbrokers. The stockbrokers would then buy positions in the stock before the section was distributed. After the representatives had the option to create their own gains, they supposedly offered a portion of their benefits to Winans as a trade-off for his insight. Winans was in the end gotten by the SEC. His case was precarious in light of the fact that the section was the closely held conviction of Winans, as opposed to material insider data. In any case, the SEC in the long run sentenced Winans in view of the case that the data about the stocks contained in the segment had a place with the Wall Street Journal and not to Winans himself.